Hi, this is Lara at Elliott Wave Gold and also for Elliott Wave Stock Market with your once a week Lara's weekly analysis of US oil, gold and the S&P 500. At this time, Lara's weekly is available to the general public, but in the near future it may be available by subscription only. I'll be offering a once-only awesome grandfather rate to earliest subscribers when I launch it as a paid subscription, and so to make sure that you don't miss out and not get your grandfather rate, to be notified, go to the website and click on the Notify Me button and give us your email address. And I'll only be using email addresses collected from that button for that once-off purpose of notifying you of launching this new product, and after that I'll be deleting them. This oil analysis will look at monthly and weekly charts. I'm going to cover Elliott Wave analysis and classic technical analysis. The outlook for oil is still bearish while price remains below 66.65, but if we see a new high by any amount above that price point, then the analysis would change to quite bullish. For the very short term, I'm still looking for a little bounce to end a bit above 63.28, a possible target at 65.05, and then the continuation of a new downward trend. Let's have a look at the Elliott Wave counts first. I have a main and an alternate wave count. This is the main Elliott Wave count. Both my wave counts expect a zigzag for a supercycle degree second wave. Zigzag subdivide 5, 3, 5. The difference between the two wave counts is where I'm seeing cycle wave B, this three-wave zigzag. If it was over here at the high of this sideways chop, then that's where cycle C begins, which means cycle C would most likely be an incomplete 5-wave impulse, subdividing 1, 2, 3, 4, 5. If 4 continues any further, it can't move into wave 1 price territory. Full and final invalidation of this bearish wave count would come with a new high by any amount at any time frame above 74.96. This wave count has really good proportion between the zigzags of primary waves 2 and 4, primary 2 lasting 22 months, primary 4 lasting 23 months. There isn't very good alternation though. They're both zigzags, and both zigzags have a contracting triangle in the B wave position. Within primary 2, the triangle is a regular triangle. Within primary 4, the triangle is a running triangle. So there's just a little bit of alternation there. There is good alternation though in depth. Primary 2 is very, very deep at 0.94 the length of primary 1, and primary 4 is relatively shallow at 0.47 the length of primary 3. The target I'm calculating is at primary degree. If I were to calculate a target at cycle degree, it ends up either in a huge truncation or the target calculation is invalid and that it brings us into negative price territory. That's not possible. And so I'm calculating the target at primary degree. The most reasonable target I can find is for primary 5 to reach 0.618, the length of primary 3 at 13.39. If that target's wrong, it may not be, but it may not be low enough. But once we have structure within primary 5, specifically when intermediate waves 1, 2, 3 and 4 are all complete, then toward the end of primary 5 I'll be recalculating the target at intermediate degree. At that stage this target will probably change. I'll be looking for strong support at the lower edge of this Elliott channel. Draw a channel around a correction using Elliott's technique from the start of the correction to the end of the B wave, and then place a copy on the end of the A wave. This upper trend line isn't perfectly showing us where price is always finding resistance and support. It often is. Some bounces here, resistance here, a slice through here, and it's a roundabout where price is finding some resistance in the last couple of months. It may continue to do so. Okay, let's take a look now at the weekly chart where the low for primary 3 is this point down here. Here's primary 4 zigzag subdividing 5, 3, 5. This may be where primary 3 has begun. Along the way down we might find some support at the lower edge of this channel. Draw this channel again using Elliott's technique for a correction from the start of the zigzag to the end of intermediate B within it, and then place a copy on the end of intermediate A. If price just slices through this trend line, then look out for a bounce and a back test to resistance at previous support. This lower trend line is showing us where price is finding support when it gets down there. If it slices through and we have a bounce and a test of resistance, that could offer a perfect entry opportunity to join at that stage an established or somewhat verified downward trend. Let's take a look now at the daily chart where the end of intermediate B. There's this point down here. Here's the impulse for intermediate wave C with all the subdivisions. From this high to this low, minor wave 1 will subdivide as a 5-wave impulse at all time frames. I'm looking here at hourly and lower time frames to check the subdivisions. It looks like with this slow sideways chop that minor wave 2 is an incomplete double combination. The first structure in the double, a zigzag labelled minute wave W. The double is joined by a 3 in the opposite direction labelled X. This is an expanded flat. And here we may have an expanded flat for minute wave Y. By far the most common combination of two structures within a double combination is a zigzag and a flat. And the zigzag is usually the first of those two structures. And so this follows a very, very common pattern, and second wave corrections certainly can be combinations. They are most often zigzags, but they just don't have to be zigzags. And so here I'm expecting minute wave Y is an expanded flat subdividing 3, 3, 5. So I'll be expecting a 5 up for a little C wave at minuet degree to move at least slightly above the end of A to avoid a truncation, and the target is for it to reach the most common Fibonacci ratio for a C wave within an expanded flat, that of 1.618, the length of minuet wave A. When minor 2 is complete, I'll then be expecting a downward wave with a very clear downward trend to show an increase in downward momentum and probably to have some support for volume as a third wave down unfolds. Minor 2 may not move beyond the start of 1 above 66.65. At the monthly chart level, this is a very bullish alternate, still seeing the end of a first wave and the start of a second wave here, but it's possible the second wave could be a complete zigzag subdividing 5, 3, 5. And like I said on that last monthly chart, the difference between the two wave counts is where we see wave B ending. If it ended here and not here at the high within this sideways chop, if it ended here, then this is where wave C begins, which means wave C could be a complete 5-wave impulse, and it looks pretty good as an impulse. If cycle B is over here, then primary C is not truncated. It has moved above the end of primary A. The term truncation refers to where wave C ends in relation to A, or where a fifth wave ends in relation to a third wave, not where it ends in relation to the correction that comes immediately before it. Here, primary wave B is labelled as a rather rare 9-wave contracting triangle. All the subdivisions fit and it looks pretty good. This is possible. And so if we've got a zigzag over down here, then a big third wave at supercycle degree may have begun. And it's beginning a little bit slowly with a couple of overlapping first and second waves and a little bit of a chop within the start of the primary degree third wave. Let's take a look at how this looks at the weekly chart level, where the low of supercycle wave 2 is this point down here. I've resolved a problem I had last analysis within this wave count. So far within the new bull market we could have 1, 2, 1, 2 and now 3, 4. We need 3, 4, 5 to complete the first impulse up. The problem I've resolved is the 5-wave structure of intermediate wave 1. We could see it as 1, expanded flat for 2, impulse for 3, running contracting triangle for 4, short little impulse for 5, which moves beyond the end of 3, so there's no truncation. And again, 5 doesn't move beyond the price territory of minor wave 4, the correction that comes immediately before it. And so now, from this low to this high, this does look like a pretty good 5-wave impulse. It meets all Elliott Wave rules, and the subdivisions have a reasonable fit. And so I've resolved that problem I said in last video of trying to see this as a 5-wave structure, when in last video I was seeing intermediate 1 ending here and it looked like a 3. If it's over here it will fit nicely as a 5. Now the zigzag for minor W here, the start of the double zigzag for intermediate 2, doesn't have quite as good a look. It could be a zigzag. We can see this as a 3-wave zigzag. It will fit at lower time frames, but I think it's probably not. It's probably more likely a 5-wave impulse. And that right there is the crux of the problem with Elliott Wave. Quite often it is absolutely impossible to tell if a wave is a 3-wave zigzag or a 5-wave impulse. It all depends on how many of the little subdivisions within it you count and what degree to label them. And so when a move like that could fit as either, you have to consider both possibilities. That's the biggest difficulty with Elliott Wave. If we've got a second wave correction here and a third wave impulse over here, then the fourth wave is probably incomplete. Minus C would be very likely to move at least slightly below the end of A to avoid a truncation, and intermediate 4 may not move into intermediate wave 1 price territory. Note that this invalidation point does not change even though I've moved the end of intermediate wave 1 up to here. The rule for the fourth wave overlap is wave 4 may not overlap wave 1 price territory, and this is the extreme of the price territory within intermediate wave 1 still. Okay, let's take a look at some classic technical analysis. Nothing really to add because we don't have a new completed monthly candlestick. My only point is that at this high we do not have a candlestick reversal pattern, and this candlestick for February, now it's complete, has a bullish long lower wick. It didn't have support from volume within the month for downward movement either, and so the short-term volume profile looks bullish and the candlestick looks overall more bullish than bearish. RSI is neutral, there's still room for price to rise, there's also plenty of room for price to fall. MACD is still bullish, and on balance volume at the monthly chart level is still bullish. What about the short-term picture for the daily chart? It looks like price is in a sideways chop with overall some decline in volume. And so it looks like price is consolidating, and a decline in volume is pretty normal during a consolidation. Downward movement of recent days, these 2 days have more support from volume, and so within this consolidation, the strongest volume days are downward, suggesting a downward breakout may be more likely than upward. Now, like I keep saying, that doesn't always work, but it works more often than it fails. There's nothing in classic analysis, or Elliott Wave for that matter, there's nothing in any of it that is absolutely certain. We're dealing with a balance of probabilities. We have to take a whole bunch of information and weigh up each little piece alongside each other and make a conclusion about what we expect price is most likely to do next. ADX is telling us that the daily chart time frame, there's no clear trend, it's declining, and the DX trend lines are whipsawing about each other. ATR is overall flat, that's normal behaviour for ATR during a consolidation, and Bollinger Bands are contracting, also really normal during a consolidation. And so with price coiling like this, it's winding up potential energy ready for a breakout. If we get a break above resistance or a break below support, preferably a day with stronger volume, particularly an upward breakout needs volume to support it, then I'd expect we've broken out of this range, and I'd expect price maybe in the next trend. And volume tells us the most likely direction for the breakout is downward at this stage. Now that could change if we see a strong upward day with volume that's stronger than this downward day here, then I'd say the breakout would most likely switch to upward. But right now, with the information we have at hand, the breakout is more likely looking like it's downward, and that would overall support the Elliott Wave count, the main preferred count. I want to watch on balance volume again really carefully. It's moving higher, we still don't have a breakout. I've drawn this resistance line, but it's only just able to be drawn. Likewise, the support line, only just able to be drawn. These lines have some technical significance though, because they don't have a strong slope. They're not very close to horizontal, but they have only a weak slope, hence some technical significance. On balance volume is coming up pretty close to resistance. There's just a little bit of room for it to move higher. That's possible. We could have some more upward movement before it finds resistance. If we see a very clear break above resistance from on balance volume, then I'd be looking for an upward breakout from this consolidation. Likewise, if on balance volume gives us a bearish signal with a break below support, I'd be looking for price to be having a downward breakout from that consolidation. So watch this really carefully next week on balance volume. Both stochastics and RSI are neutral. There's plenty of room for price to rise or fall. What about volatility index? There's a little bearish signal from volatility index. Price on Friday made a new high above the prior high 3 sessions ago, but the volatility index had not made a corresponding new low. That tells us this rise in price does not come with a normal decline in volatility, and that's a bearish signal. However, I will also note that at this stage, the oil volatility index and the oil price do not have a reliable enough correlation. This is quite often the case. These two sets of data at this stage have too weak a correlation to say that they are actually properly correlated. Any correlation coefficient that spends time between the 0.5 and negative 0.5 in this shaded area, we should not assume that the correlation is reliable enough for us to assume that movement in one market will mean the other market should move in a certain direction, whether it be negative or positive. I hope that makes sense. I'll be expecting the upward swing to resume. It may be choppy and overlapping. The target is 1391, but that may be too high because there's really strong resistance ahead, about 1365 to 1375. However, there's a bearish signal this week from on-balance volume after Friday's downward movement for the daily chart, and that puts this upward swing expectation into some doubt. If price can close below support at 1305, then a downward breakout from a small consolidation may be underway. Let's do classic analysis first this week, because that's what I've just been referring to in that initial comment. This is the weekly chart for gold spot price. This is the small consolidation I'm referring to. There's resistance about 1365 to 1375, and there's some really strong support here about 1310 to 1305. This support's been tested a few times, and so far for the short-term consolidation has held. The more often resistance or support is tested and holds, the more technical significance it has. And so in order for a bearish outlook for gold to have reasonable confidence in that outlook, we really would need to see a close below this support zone, which has its lower edge about 1305, before we can have confidence that we've got a downward breakout. We've got downward movement for the last couple of weeks. We've got red candlesticks anyway, and it's coming on declining volume. Now, we don't have to have support from volume to have confidence in a downward trend. The market can fall of its own weight, but it is nicer to see, or we can have more confidence in a downward movement if there is support from volume, and here we don't have that confidence. On balance volume at the weekly chart level for gold is at support. But, as you'll see in a moment, at the daily chart level, we've got a little breakout. ADX is still declining at this time frame, telling us there's no clear trend at the weekly chart level, and price is range bound in this small consolidation for the shorter term. For the longer term, gold is range bound within this bigger consolidation, which has an upward bias with a series of higher highs and higher lows. For that upward bias to be shifted to a bigger downward bias at this time frame, we would really want to see a new swing low below this point down here. We haven't had that, and so until we've got that, you have to admit that this is an upward bias, but it's very choppy and overlapping, so I'm going to consider it's more likely a consolidation, and that's what ADX tells us at the moment as well. While price has been slowly moving higher within this range, ATR has been consistently for a very long time now declining, and now it's overall flat. And so that's typical behaviour from ATR when price is consolidating. So that's another reason why I'm calling this a consolidation, even though it has a slow upward bias. RSI and stochastics at the weekly chart level are both neutral, not giving us an indication either way. There's plenty of room for price to rise or fall. Here's a large portion of that trend that has the upward bias, and I'm zooming out at the daily chart level so we can look at volume. Here's one trick: when you have a consolidation for price and it's range bound, look at which days or weeks or months have strongest volume. Best to look at days. Here it's 2 upward days within this big movement which have strongest volume, suggesting that an upward breakout may be more likely than downward. Within this smaller consolidation, which price entered back here and has been range bound with resistance about 1365, support about 1310 to 1305, this previous strong area of resistance and support. It's this upward day within the smaller consolidation also, which has strongest volume. So volume is suggesting that an upward breakout might be more likely than downward. Now, that trick does not always work. It just works more often than it doesn't work. There's nothing in technical analysis which is certain. We're dealing with a balance of probabilities, not certainties. So we look at a bunch of evidence and try and weigh it all up and figure out what's the most likely direction for price. To have confidence in a downward movement, I would really want to see on the daily chart a close below support at 1305. Now, for confidence in a downward breakout, we don't have to have support from volume for that downward day, but if we do have support from volume, then we can have more confidence in it. For Friday's downward day, there's a little bit of support for downwards movement from volume. It's good to see, but we still have for most recent days a couple of upward days here which have more support. So overall, the volume profile for the short term, on balance, I would be reading that as a little bit more bullish than bearish, but we do have this bearish signal here from on balance volume breaking below the support line. RSI and stochastics at the daily chart level are also both neutral and prices range bound, so there's still plenty of room for price to move higher or lower within that range. ADX at the daily chart level is below 15, so it's too low at this stage to tell us that we have a trend, and ATR is now declining for a couple of weeks after sitting flat, and again that's typical behaviour from ATR of when price is in a consolidation. Also Bollinger Bands overall are steady. That's quite typical when price is range bound, consolidating. Okay, let's have a look now at the Elliott Wave count. I have 5 Elliott Wave counts at the weekly chart level, so again, in order for this analysis to be manageable for me to publish and digestible and understandable for you to read, I'm going to publish this bullish wave count, which would be my preferred wave count, because I think it has a little bit more support from classic technical analysis, and a very bearish wave count to cover the bearish outlook. I'm linking back at the beginning of my text article every day to that prior historic analysis where for members you can look at all 5 of those weekly wave counts. They cover different scenarios, and most of them either cover a bullish or a bearish scenario. So in terms of direction, I'm covering them all with these 2 charts. Most of my wave counts see cycle wave A ending here and a B wave at cycle degree beginning here, and that's the reason why there are so many wave counts, because B waves can subdivide as one of more than 23 possible corrective structures. So when B waves are unfolding, it's essential to be flexible with your analysis and cover alternates. It's impossible to tell which of those multiple structural options this B wave may have taken until either close to or at its end. At this stage, all I can say is it looks very unlikely to be over. Cycle degree waves should last 1 to several years, and so this looks about right in terms of expected duration. This first wave count looks at cycle B as a single zigzag subdividing 5, 3, 5. And the only problem with this wave count is this upward wave, labelled primary wave A, you have to admit has more of a 3-wave look than it does as a 5. If any of these wave counts and all of the 5 have problems, I'm noting them on the chart so you can compare and contrast them all and be quite clear about what the problems are within each of them. No problems here. This subdivides nicely as a zigzag for primary wave B. Primary B is less than 90% the length of primary A, so we can't relabel A as a 3. With B as a 3, that would be violating an Elliott Wave rule. That would be indicating a flat, and B would be less than the minimum 90% requirement of A, so the rule for a flat wouldn't be met. Such a wave count would be invalid. And so this must be a zigzag if this labelling of A and B is correct here. And so C, that primary degree, would have begun here. All of this choppy overlapping at this stage indicates a diagonal, an ending diagonal for primary C. Within an ending diagonal, all of the subwaves must subdivide as zigzags, and the 4th wave must overlap first wave price territory. The Elliott Wave rules for diagonals are quite different to Elliott Wave rules for impulses. So we have a zigzag for 1 and 2 and 3 is longer than 1 and 4 is longer than 2. So the diagonal is expanding. The trend lines diverge, so that meets the rule for trend lines for an expanding diagonal. And so the fifth wave should be longer than the third, and so it must end above 1398.41, which is the price point where it would reach equality in length with the third. The fifth wave must also subdivide as a zigzag, subdividing 5, 3, 5. Within it, B may not move beyond the start of A, but if it got down that low now, it should find pretty good support at the 2, 4 trend line, because like triangles, diagonals should adhere quite nicely to their trend lines. We've got a couple of small overshoots within this one. That's okay. Price quickly reversed and moved back in. These are just overshoots, not breaches. Here's an example of a triangle adhering really well to its trend lines. Diagonals usually do the same kind of thing. Okay, let's take a look now at this zigzag for intermediate 5, where the end of intermediate 4 down here is this point. So intermediate 5 needs to subdivide 5, 3, 5. Now we come to the problem that we're in a B wave at minor degree. I'm just going to quickly go back to that weekly chart, because let's have a look at how long I'm expecting this B wave to be. Because intermediate wave 5 is expected to be longer in price than intermediate wave 3, it's reasonable also to expect it to be longer in duration. That would be a normal look for the fifth wave of an expanding diagonal. Because I'm expecting intermediate 5 to be longer in duration, it's reasonable therefore to expect minor B within it to probably be at least as long, if not longer, in duration than minor B within intermediate wave 3. Within intermediate wave 3, minor B lasted 12 weeks, and so I'm expecting minor B here within intermediate wave 5 to last either a Fibonacci 13, or possibly even 21 weeks. At this stage, minor wave B has just completed its 7th week, so it's about only a little bit over halfway through. Okay, let's go back to that daily chart now, where the end of intermediate 4 is this point here. So here we have the zigzag for intermediate 5, subdividing 5, 3, 5, and minor B within it, just over about halfway through, so an incomplete structure. And now again we come to the problem that here we have a B wave, and there are more than 23 possible corrective structures that it can take, and if we're only just about halfway through, then there are multiple structural options still open for minor wave B. And at this stage I think it's most likely going to be a flat correction, but it could also be a triangle or combination, so plenty of options still open. It looks like we may have a zigzag complete down here. This could be minute wave A of a flat or minute wave W of a double combination. It looks like an A wave ended here and a B wave began here, so now we're in a B wave within a B wave. And it's nested B waves, which really are the absolute worst. They're extremely difficult to analyse, usually present horrible trading opportunities. They're analogous in classic analysis terms to range-bound consolidations, which is exactly what I was describing on those classic technical analysis charts. And so we'll expect swings from resistance to support and back again, and when price is consolidating, and it does that, it doesn't move in straight lines. It's choppy and overlapping, characterised often by contracting Bollinger Bands and declining or flat ATR. Horrible trading opportunities, which is what we've had for the last few weeks, most frustratingly. This market will begin to trend again, but it's not doing so yet. If A is over here, then we've got the problem of what structure is minute wave B within minor wave B. I'm labelling it here as a possible flat correction, subdividing 3, 3, 5. It could be still one of many possible structures. The only ones I can eliminate would be single or multiple zigzags, because minuet B moves beyond the start of A. So I can't label minute B as a zigzag 5, 3, 5, because for a zigzag B can't move beyond the start of A. So it could be a flat, it could be a combination, it could also be a triangle. It looks most likely to be a flat, and if it's a flat, then it would be an expanded flat. These are very common structures where B moves beyond the start of A and is a 1.05 length of A or longer, and the most common Fibonacci ratio for C to exhibit is 1.618, the length of A, so that's why I've calculated the target at 1391. But if this target is wrong, I think it's going to be probably too high by at least $15, possibly more. It looks rather optimistic because there's very strong resistance above for price to overcome before it could meet that target. Minuet C would be expected, though, to be very likely to move above the end of Minuet Wave A to avoid a truncation and a very rare running flat. Minuet C needs to subdivide as a 5-wave structure. So far we may have one, a deep second wave correction, and now looking for a 3rd wave up next week, and then a 4th wave and a final 5th wave. So choppy, overlapping movement on the way up, another consolidation for sub-Minuet 4. At the daily chart level, this is an alternate idea. It's identical to that first chart I showed you right up to the high here of minor A. We're still looking at this zigzag of intermediate wave 5 within the ending expanding diagonal of primary C. And now we're looking at another possible structure for minor B. It could be a triangle, a double zigzag for A, a single zigzag up for B, and then we'd need C, D, and E. So choppy, overlapping sideways movement in an ever-decreasing range, possibly for another 5 to maybe even 14 weeks in total to complete a complicated, time-consuming triangle. At the weekly chart level, this is my very bearish wave count. This is the most bearish wave count I have. Still seeing cycle A over here and cycle B beginning and incomplete. Cycle B subdividing as a flat correction, which subdivides 3, 3, 5. Primary B can't be over here because that would be less than 90% the length of primary A, and so primary B, if cycle B is a flat, primary B would be continuing further. It may subdivide as a flat correction. It can be any corrective structure. Here it could be a flat subdividing 3, 3, 5. So we'd be expecting a downward breakout and quite a lot of really strong downward movement for an intermediate wave C. The target for intermediate C is for it to reach 1.618 the length of A at 958, so that primary wave B reaches below 1079.13, meeting the minimum requirement for the flat correction in relation to primary wave A. Then we would have 3, 3, and we'd expect a huge trend change and a big upward wave for primary wave C. We can have confidence in this wave count at the weekly chart level if we see a new low by any amount at any time frame below 1236.54. We do not need a close below this point. It's just a low by any amount. Even a fraction of a cent on a tick chart is enough to give us invalidation of that first chart and confidence of this bearish outlook. That basically means a new swing low below this point, and as I said on that classic technical analysis chart, that really is what we would have to see to change our view from this upward movement, this upward bias that gold's been in now for well over a year. For the very short term, I'm expecting a little bounce to continue. The target for it to end is about 2789. It's a B wave, so it could be choppy and overlapping. It may last another 1 to few days, and when it's done, I'm expecting another downward wave to develop. Elliott Wave analysis first, classic analysis last. For the S&P, I'm seeing a big cycle degree 4th wave over here and a big cycle degree 5th wave unfolding as an impulse. So far we have 1, 2, 1, 2, 3, I think 4 is still underway, and then we'll have the 5th wave to end primary 3, another big 4th wave correction, and then a final 5th wave up toward one of these targets. The first one is looking too low. The second one now looks about right. That would allow enough room for upward movement to continue in the structure to complete. I have an alternate which looks at the possibility that intermediate 4 could have been over here, and if it was over here, there's still fairly good proportion at the weekly and monthly chart levels in comparison to intermediate 2. Intermediate 4, if it was over here, would have been much quicker at only 2 weeks, but because it's travelled such a good distance, it shows up nicely at the weekly and monthly chart levels, as does intermediate 2, and so overall it still has a good proportion. But if it were to continue further, then it could possibly have an even better look. Intermediate 4 may not move into wave 1 price territory, below 2193.81, but it shouldn't get anywhere near that point. If it were to be very deep, it should find really strong support at the lower edge of this big teal channel, which I'm copying over from the monthly chart. That's the bottom line for a bull market for the S&P. While price remains in a bull market, then I will expect good support at that trend line. If this trend line is breached, then I would expect a trend change from bull to bear. That would be the earliest indication possibly. Okay, let's have a look at the first of a few daily charts where intermediate 3 high is this point here. This is my preferred wave count for intermediate 4 to continue because it would see intermediate 4 continuing to find good strong support about the 200-day moving average. This looks at intermediate 4 possibly being a regular contracting or regular barrier triangle with a zigzag for A, a zigzag for B, looking for a single or double zigzag down now for C, and then a zigzag up for D, and a zigzag down for E to fall short of the AC trend line. Only when minute waves A or W within minor wave C are complete can I calculate a target down for minor wave C to complete for you. I can't do that yet. I would expect it to find good support at this trend line and end somewhere close to the 200-day moving average. That's, at this stage, my moving target for minor wave C. I absolutely can't give you an idea of where minor wave D may end. If this is a regular contracting triangle, then D may be about a 0.8 to 0.85 length of C, and because we don't know how long C is, that's impossible to tell where D might end. But intermediate 4 could also be a barrier triangle, and D could end about the same level as B. Contracting triangles are more common than barrier triangles, but barrier triangles aren't exactly rare, so we have to consider that possibility as well. So because of that variety open, it's absolutely impossible for me to give you any idea at this stage of where D may end. Minor wave C, if we're looking at a triangle, may not move beyond the end of A, below 2532.69. Now another option for intermediate 4, it's all the same to this point here, looks at intermediate 4 possibly as a double combination, with a zigzag for the first structure in a double, labelled minor wave W, the double joined by a 3 in the opposite direction, labelled X, and now looking for probably, most likely, a flat correction for minor Y to subdivide 3, 3, 5. Minute wave A most likely to be a zigzag. I think this is less likely because at its end, minor wave Y, to end about the same level as W, would see a huge overshoot of the 200-day moving average, and if the bull market continues, I'd be expecting price to probably find pretty good support there. It looks less likely that we're going to see such a massive overshoot. At the daily chart level, here's another idea for minor wave 4, that of a flat correction, subdividing 3, 3, 5. If we're looking at a flat correction, then minor B within it has still not met the minimum requirement of 90% the length of minor A. That's achieved at 2838.85. If minor B is continuing, it may be a zigzag subdividing 5, 3, 5, but now the size of minuet wave 4 just looks to be too big in comparison to minuet wave 2 for this to be a good looking wave count. It just doesn't really have the right look anymore. I'll wait until it's properly invalidated though. If we get a new low below this point, minuet 4 can't move into wave 1 price territory below 2732.08. If we see a new low by any amount at any time frame below that price point, that's enough to invalidate this idea as I have it labelled for a flat correction. Now it could also be possible that minor wave B could be a double zigzag. We could have W, X, Y. I could relabel it like that. So if this is invalidated, then that's probably how I would have to consider minor wave B continuing higher. The possibility that intermediate 4 is still continuing as a flat correction would still remain, even if the way I've labelled this here is invalidated next week. There's still multiple structural options open here. The target here is for minuet wave 5 to reach equality in length with minuet wave 3 at 2842. At the daily chart level, this alternate idea looks at the possibility that intermediate wave 4 could have been a quick zigzag over in just 2 weeks, as I outlined for you at the weekly chart level. If it's over here, then intermediate wave 5 must have begun here and can only be one of 2 structures. It can only be an impulse or an ending diagonal. So far, it's probably an impulse. We may have 1, 2 an expanded flat, and 3 unfolding upward would reach 1.618, the length of minor 1 at 3006. Within minor 3, we may have minuet minute 1 and minute 2 could be over here, but it most certainly could move lower and the wave count would still have a good look and good proportion. It can't move beyond the start of 1 below 2647.32. This invalidation point is lower than this invalidation point. Here I'm looking at this choppy overlapping movement possibly as a diagonal. Now I'm not going to consider it an ending diagonal for intermediate wave 5 in its entirety because it would at its end be truncated, and ending diagonals are almost never end in a fifth wave position as a truncation, so that would be extremely unlikely. I will consider it as a leading contracting diagonal though for minor wave 1 within intermediate 5. The diagonal is contracting because minute 3 would be shorter than 1 and minute 4 must be shorter than 2. Minute 4 would reach equality in length with 2 at 2660.07, so if price reaches down to that point or below, the diagonal structure here would be invalid as I have it labelled. For newer members who are newer to Elliott Wave, I'm labelling these waves, these subwaves here, as zigzags because within diagonals, the subwaves are almost always zigzags. Within leading diagonals, the first, third and fifth waves are most commonly zigzags, although they sometimes can appear to be impulses. When this diagonal could be complete with a small overshoot of the 1-3 trend line, if price moves up here, overshoots this little line and then very quickly reverses and starts to move down quite strongly, this wave count could then possibly increase in probability. We could have a diagonal complete. We could then be looking at a deep, very deep second wave correction. It might be deep enough to come back down to test the 200-day moving average, because a second wave correction following a leading diagonal in a first wave position is very commonly very, very deep, deeper than the 0.618 Fibonacci ratio. Minor wave 2 may not move beyond the start of 1 below 2532.69. Let's have a look at the classic analysis this week. This week completes an upward week. It's got a higher high and a higher low, but the balance of volume was downward. And we have a little bit more support for downward movement within the week than we did for previous upward movement. But really we need to look inside this week at the daily volume bars to draw any conclusion really about the short-term volume pattern here. There's a little bit of distance to go before on-balance volume will find support. I'm not drawing another support line from here to here. That would be breached, but it has a bit of a slope. It's not long held and it's only just able to be drawn. So the technical significance of such a trend line I think would be too low really for us to consider it. So just in case anyone was wondering, that's why I haven't done that. RSI is neutral, telling us there's plenty of room for price to rise or fall. This pullback has managed to bring RSI down from extremely overbought, and it was there for quite a long time. It's also brought ADX down from a very extreme upward trend, so there is again now room for a new trend to develop and for price to move quite a bit higher. MACD remains bullish. It is a lagging indicator. What about the short-term picture at the daily chart level? We had what I was expecting was a measuring gap here, but now that's closed, and so we have to correctly label that now as an exhaustion gap. So this upward wave is over and we've got a new downward movement. We've got a long upper wick for Friday's session. I'm not reading this as a candlestick reversal pattern. It could be a gravestone doji, but it doesn't come after an upward movement. It's within a downward movement, so it's not a candlestick reversal pattern. Friday's session was an inside day, and it has an increase in volume. The balance of volume was upward, but I'm not going to read this as particularly bullish, this huge volume spike, because it's an options expiry day. But we do have a little bit more support for upward movement within Friday's session than we have for the last 3 downward days, which came on falling volume with falling price. ADX is still declining, telling us at this time frame there's no clear trend. ATR slowly declines, quite typical for when price is in a consolidation. And Bollinger Bands contracting, also quite typical when price is consolidating. Price has got resistance about 2815, next support here about 2700. So far this consolidation has a bit of an upward bias. In order for that bias, that outlook of an upward bias to change, we would really need to see a new swing low below this point down here. On balance volume has got a new range. We're able now to draw a resistance line and a support line. There's some technical significance here because these lines are close to horizontal, but they're not too long held and they're only just able to be drawn. But I will take either a bullish or a bearish signal if we can break above resistance or below support. In the first instance, if price moves lower and on balance volume moves lower, in the first instance we'll expect support that may assist to halt a fall in price. RSI neutral, stochastics back down from neutral. It may possibly now return from overbought. It may only get again to the halfway mark, or it could possibly get further down into oversold. MACD at this time frame is still bullish. So the picture's unclear. It looks like price is consolidating, and for the bigger picture, for my Elliott Wave counts, expecting that price is still within a fourth wave at intermediate degree would fit that view overall. What about inverted VIX and the AD line? Do we have any signals here? We do. We have from inverted VIX, we've got price has not made a new high above the prior high 2 sessions ago, but inverted VIX has. I'm reading this as a leading indicator, so this is a bullish signal. And we've also got the same thing from the AD line. The AD line has made a slight new high below the prior high 3 sessions ago, but price has not. If the AD line is a leading indicator, then this again is a bullish signal, and that gives me quite a lot of confidence in my short-term outlook for another 1, 2 or 3 upward days to start next week, and it could be quite choppy and overlapping. That's all from me this week with your oil, gold and S&P analysis, and I hope that all of our viewers and all of our members are having a most fabulous weekend.